I want to welcome you to the continuation of deferred taxes. On this one, we're going to cover valuation of a tax and the different tax rates, if you expect different tax rates to come about. The valuation, as I have up at the top there, the valuation allowance is used if it's determined that some of the deferred tax asset will not be used. So what we have here is we have a deferred tax asset of $6 million. A temporary difference of $20 million. Taxable income is $90 million. Tax rate's 25% again. But this time, the company, for some reason, has only estimated that they're only going to be realizing 40% of the deferred tax asset, which means 60% will not be. And we want to show you how to take care of that. Okay. So the deferred tax expense, we skip. Deferred tax asset, remember, is an asset, so that's equal to the $6 million. The income tax payable is the taxable income times the 25%, or $22.5 million, which means your tax expense then would be 22.5 minus the 6, or $16.5 million. Okay. Now, to take care of the valuation, we'd have equal the 6 million times 1 minus the 40%, because we want to put in here the amount we're not going to realize. So that's the 3.6 million. And that's what the valuation is. It's kind of an offset if you want to look at it as an offset for the deferred tax asset. Or the other way you can do this is you could have, that's the 6 million. Income tax payable is the 90 million times the 25%, just like we did before. This one is equal to the 6 million times 1 minus the 0.4. And then the income tax expense is what makes it balance. Equal plus minus, so the 20.10, and it's those two added together. Either one of these is acceptable. This is the 2 journal entry method. This is the 1 journal entry method. You just simply combine the two. So, you have to watch the wording on this. Sometimes they'll tell you that this is in percent we think we're going to realize, or they may come out and say we're not going to realize the 60%. And what you want is the unrealized portion of the tax asset. All right. Now, what happens if you have a different tax rate? Well, here's an example. We have 291 million as a pre-tax income. Taxable income is 300,000, not million, 291,000, 300,000. Difference is a warranty of $9,000 over 3 years. Because for tax purposes, this is an estimated warranty that you deduct from your financial statements, but you can't do it until you actually pay out the warranty for tax purposes. So that's what this is here. And then we're expecting the tax rate change to 20% in 2023 and 2024. Because the tax rates you want to use are the tax rates that will be in place when you realize the differences. Okay, so that's why we just put in the 2024. And if the tax rate changes, you reevaluate things. Okay, so we'll have a pre-tax income of 291,000. Warranty expense is the 9. And now over here, I want to take equal, and I did the minus sign, the 9 divided by 3, because it's going to be over 3 years. Okay. So the taxable income then is, you add those two together, because like I said, you can take it for tax purposes, but not for income tax purposes. Tax rate is 25%. So it's 300,000 times the 25%. Okay, or 75,000. Okay, now this one again I'm just going to copy those down, and the 20%, and I'm going to, oops, I can't do that. I take the 3,000 times the 25%. Now on this one, I want to take the 3,000 times the 20%, and here's the 3,000 times 20%, for a total of, I don't want the 70, I just want the, there, 1950. Now the reason why this is negative is it's a tax asset. You wouldn't really need the negative signs in there, but okay. So the tax asset is 1950. The tax payable is the 291,000 times the 25%, 72, whoops, taxable income. Grabbed the wrong one, didn't I? Oh, right there, tax payable. I grabbed the wrong one. 75,000, I already had it figured out. Yeah, so that's the pre-tax income. I want the taxable income. See, you have to watch yourself. So it's the 300, it's the 75,000 there. I already had it done. And then the 75,000 minus the 1950, and that's your income tax expense, and the $73,050. Okay. I'm going to leave that mistake in there because I can show you it's real easy to grab the wrong one. Make sure you grab the taxable income to get the tax payable and not the pre-tax income. Okay, so that finished up our discussion on the deferred taxes anyway. And we concluded with the valuation method that you have and the different tax rates. And what you do is you just reevaluate things at the end and just do it that way. So thank you for watching, and hopefully you picked up something, and I'll see you in the next video.